We'll start with the introduction, then introduction to the speaker. We'll have a session for Q&A at the end, the last 15 minutes. However, if you feel like you have a question as the session is ongoing, please feel free to put it in the chat, and then once we get to the session, we will get to the question. So who are we as Investia? We are a project finance advisory, project and corporate finance advisory company. We have services in these 4 sections, which is project and corporate finance, financial modeling training, as well as building and audit, capital raising, mergers and acquisitions, and acquisition support, and then public sector modeling. This is just a brief track record of what we've been able to do in the various sectors, such as fundraising. These are the clients that we've worked with. As you can see, Tigoni Growth, Tata, just to mention a few. And then on valuation, we have worked with Macefield, Aller, Copia, to mention a few again. In due diligence, again, we've worked with a couple of companies, as you can see on the screen, Consonance, Viban, Kuramo, and Larry Limited. Mergers and acquisitions, we've worked with Pontibrid, Nation Media, and so on. For training, we have trained diverse sectors, as you can see on your screen. We have the Unga Limited, Family Bank, Jaguar Petroleum, Horizon Africa, the National Treasury. Why this series? We started this series because we thought there was a gap in the market, and we aim to inform and educate on the relevant matters, such as what we're talking about today, which is the depreciation of currency and what the impact it has. We hope by the end of this program, you will have a bit of insight of how to navigate these challenging times. Again, support you in challenges, and we are hopefully you can network, and that's why we are asking you to introduce yourself in the chat section so that you know who's in the room and maybe how to collaborate. We have been doing the webinar series for quite a while, ever since COVID started. And some of the topics that we have covered include Excel shortcuts, how to Excel to weather the economic impact of COVID-19, strategy in turbulent times, the role of PE and VCs in spurring the SME sector in Africa. And you can catch all this in our YouTube channel. The link is as below, but I'll also post it in the chat box for you to have an easy time to locate it. That is our contact information in case you want to reach us. That's our website, and you can also email us at info@investia.com. Without further ado, I know you did not come here to listen to me, you came here to listen to the panelist. I will invite Kezia to invite our panelist and also start the conversation today. Kezia.
Thank you so much, Lian, and good morning to our audience. My name is Kezia Njeri, and I'll be your moderator for today's session. We'll be looking to understand the impact of depreciating Kenya shilling, and we have our guest speaker, Mr. Ken Gishinga of Mentoria Economics. Ken, may I invite you to introduce yourself and to introduce your firm before we can start the conversation. And we look forward to an insightful engagement and from participation from the audience. Thank you. Ken, over to you. Sorry, you're muted.
Okay, many thanks, Kezia and Lian. It is a great pleasure to be with the Investia team and with the attendees, who I hope we will have a great session unpacking this very important topic around currencies. My name is Ken Gishinga, and I'm the chief economist at Mentoria Economics. My background is as an economist. I hold an economics degree from Harvard University, and I really looked at the issue of entrepreneurship and how it transforms what we call Joseph Schumpeter's thesis on entrepreneurship. At Mentoria Economics, our work is to advise companies on matters of the economy, macroeconomics, micro, and also how to build their strategic plans as they use the economic details. So every Monday, we publish a global markets report, which you can find on our website, www.mentoria.co.ke. Every Monday at 8 in the morning, you can get a report on the global economy, the region, Kenya. Much of what we'll discuss today is covered in the weekly reports. So please feel free to subscribe. And also we run a podcast really on matters economics. It runs on Capital FM every Tuesday at 6:30 p.m. And my assistant Charlene will be sharing the links to that. So yeah, we live, eat, drink, sleep economics. So I look forward to our wonderful session today.
All right, thank you so much, Ken, for that introduction. And before we can start discussing the impact of the depreciating shilling, would like to first discuss the current economic condition, the good and the bad. We have complained about inflation, we've complained about, of course, the depreciating currency. What do you have to say about the current economic conditions, and what can we expect into the second half of 2023?
Well, I'll start with the good. I believe in being positive, and there are a number of things that make Kenya a good investment destination. Number one is we have a very youthful labor force. The median age in Kenya is 19 years, and it's very well educated, speaks English, is able to connect with the rest of the world. Number two, we have a very diversified economy where we are not reliant on one particular mineral. If you go to many African countries, you'll find they depend on gold or oil or something. And if those commodities are not doing well, you find the whole country is in problem. But Kenya, we are fairly diversified, whether it's tourism, whether it's horticulture. So even though we have one major shock, we're able to rely on other sectors to do well. And that makes Kenya very resilient. And number three, I'd say the infrastructure. In Kenya, it's quite elaborate. You see your expressways around you, your highways, your standard gauge railways, but also the digital infrastructure. The reason we can communicate so well right now is because of our digital infrastructure, our internet connectivity, our mobile money, M-Pesa, all these things. So these are the things that make Kenya a fantastic place to invest, and not forget sunshine. We have great sunshine in this country, and people underestimate the power of that. That said, we've had significant challenges in our economy, not least being inflation, which is quite high, 9%. Every survey that is done in the opinion polls says about Kenyans complaining about the high cost of living, and that's the reason we're having mandamanos every week. So the cost of living is quite high. Obviously, the currency, that has been affecting the currency along with other issues. And the growth that we've had, most of it has been driven by public sector growth. So we'll be told Kenya grows at about 5% year on year. But the problem with that is most of that growth is coming from the public sector. So investments in railway and roads and bridges. But what people really need is private sector growth, because most Kenyans are in the private sector. I think there's only about 700,000 civil servants, and our working force is about 20 million people. So you're talking of the vast majority of Kenyans in the private sector, and money has not been flowing in the private sector quite a bit. And right now we are undergoing a bit of a fiscal squeeze. The government is doing a bit of budget cuts, which might affect money in circulation. And also the central bank has also contributed by raising interest rates. So we are finding monetary tightening. You know, if if you have a loan with the bank, you notice your interest rates have gone up. But also with the government, you're seeing they are doing some budget cuts. So it's a tough time. A lot of Kenyans are finding themselves between a rock and a hard place, and how to maneuver that really has become really the context of daily life.
Thank you so much, Ken. And what can we expect going into the second half of 2023? Are things expected to get better or worse?
So as inflation, I believe inflation has peaked. I think it's reached its highest point. Tomorrow we'll get the latest inflation numbers. They normally come out every last weekday of the month. So I think tomorrow we should have them. And I expect those numbers to start coming down. It was 9.1. Hopefully we can start getting to the 8% range, but we are a long way off. Remember, we target inflation to be at 5%. So inflation is somewhat sticky. That's the adjective we use to describe our inflation. It's a bit sticky. So it's coming down slowly, which means the central bank, what central banks do when inflation is high, they raise interest rates. That's not always the best way, because there are two types of inflation. There's what you call the demand pull, which is just really a lot of money in the economy. And central bank tools tend to cure that very easily by raising interest rates. But the kind of inflation we have in Kenya is what you call cost push. It's coming from outside the country. It's coming from Russia, Ukraine issues. It's coming from when the wheat prices have gone up, oil prices have grown up. So central banks are not very well equipped with dealing with cost push inflations, because the events are happening outside of the country. But nonetheless, to be shown, to be seen, to be acting, they have to keep raising interest rates. So I think as inflation starts to come down, possibly the central bank will reduce the level of rising interest rates, and we might find some reprieve towards probably the end of this year. So expect somewhat tight 2023, but I think as we get into 2024, you'll start seeing some more reprieve. And really, that's also what the IMF outlook reports that came out last week really talked about, that really growth will be stunted this year, but from 2024, 2025, we expect to see quite a bit of a recovery.
Okay, thank you so much. And maybe related to that, there was an article on Business Daily where they were saying that a lot of the bids that have been going to the CBK have been rejected due to pricing. How do you see that moving into the later part of the year?
Yes, that has been quite a pertinent topic over the last few weeks. Last week, the CBK cancelled the bond auction for the reopening of the 15-year bond. Now, that's a very rare sign for CBK to cancel an auction, but I think it's because investors are becoming very aggressive. Investors are looking for very high returns, and those returns are not commensurate with what the government would like to see. So you'll find the story that came out a few weeks ago about the government not paying civil servants on time, and civil servant salaries being delayed, counties complaining they've gone 4 months without receiving cash, and them issuing a 2-week notice that they're going to shut down the counties. All these stories are picked up by investors, and investors start believing that the government is very, very hungry for cash, very desperate for cash. And when investors start believing the government is hungry for cash at any rate, they start bidding much, much higher. They place a higher risk premium, and they start bidding. So I think what you'll be seeing in the previous auctions is investors holding off, putting their money in short-term securities, treasury bills, because they believe interest rates will go up. They believe the government's hands are tied and the government needs money, so it's willing to pay for that money at any rate. So many investors are sort of hoping that those interest rates will go up. But I think the government wants to make sure that does not happen for 2 reasons. Number one, when interest rates become very high, it becomes very expensive for the government to service that kind of debt. But even more importantly, when interest rates on government securities are very high, the crowding out effect happens. You crowd out the private sector because any investor, and I'm sure you have very many investors in this webinar, will be like, why should I put my money into any project when I can get risk-free return at 15%, at 14%? So it creates what is called a crowding out effect, where you crowd out any private sector investment and all the money starts. So I think the CBK is trying to reduce the extent for that.
Okay, all right. Thanks for that detailed explanation. So on to the flesh of the discussion. So we know that the Kenya shilling has been depreciating against the major currencies, and for purposes of this discussion, we'll be looking at its performance against the USD. And in the last 12 months, we've seen a depreciation of about 20%. What would you attribute this depreciation to?
Yes, indeed. That depreciation, which is actually not new, Kenya's currency has been depreciating for quite a bit of time. Fundamentally, it's because Kenya is a net importer. It means Kenya imports more than it exports. Any country who's a net importer, your currency is always under pressure. And that's if you find the graph for the longest time, the Kenyan currency has been weakening. But I think that weakening has sort of accelerated even faster because of events in the United States, where we've seen the Fed raising interest rates because inflation in the US is also quite high. Inflation in England is in double digits. So all the global major central banks, including the Fed, are raising interest rates to curb inflation. Now, when they raise interest rates on those currencies, investors in countries like Kenya go back to the US. It's called what's called a capital flight. They go back to the US hoping to get better, higher returns in the US. And that's what we are finding in Kenya and in many other frontier and emerging markets, where currency is moving from Kenya's, the Nigeria's, the Ghana's, going back to the US with the hope of getting higher interest rates in the US. And that is really leading an even faster depreciation of the shilling. So I'd say it's a combination of Kenya being a net importer and investors just fleeing back to the US. I think if you look at the Business Daily today, they're saying foreign participation at the stock exchange is down to 30%, and it's normally at about 60, 70. So a big chunk of money has left the country, has gone back to the US, and those are the two engines driving the current depreciation.
Okay. And do businesses have a reason to get worried, or are things expected to get better?
Well, it depends on the business model you have. When our currency is weakening, there are always winners and there are losers. Obviously, the losers are the people who are importing. So if you're importing, if your liabilities are in dollars, definitely you are on the wrong side of history, if I can, because you're constantly being pounded by that exchange rate. But for somebody who is an exporter and you're earning in dollars, you know, you're exporting your avocados to China, your coffees to Europe, your flowers to England. Exporters are really enjoying this current time. Anybody who is earning dollars now is laughing all the way to the bank because their assets are in dollars, but the people whose liabilities are in dollars are hurting. So it depends on where you are in that equation. The problem in Kenya is, as I said earlier, we are net importers. So if you combine all the importers and all the exporters, we have more importers than we have exporters. And that's the reason most people are feeling the pain. So I think it's, as a country, we need to change our model to become very export oriented. I think for a long time, our model has been export raw materials to Europe, export your coffee, your teas, then you re-import your finished goods, re-import. I think we need to change that economic model. We need to start saying, you know, with our coffee here, can we do all our processing here? Can we do all the value addition in Kenya so that we don't have to import butter from Denmark, can make our own butter here in Kenya? So I think it's going to be a challenge for importers, but I think as an economist, for me, it's actually a good thing. It's going to force us to think about local production. Should we import toothpicks from China? Should we import, you know, French fries, you know, from Egypt? can we start doing our own production? So I think for the long term, it will help us think more productively about local production.
Okay, and thank you, Ken. Related to that, there was an article where IMF was encouraging the CBK to allow the shilling to depreciate freely so that there can be a push towards consuming locally produced goods and towards export-oriented businesses. Is that something that would really work, given what you're saying, that if that was the case, then possibly we could have a lot more of the local products being consumed as opposed to imports?
I think the IMF is absolutely spot on that particular area. But even the CBK has been defensive. The CBK frequently says that it has no preference for any exchange rate, that Kenya shilling is a freely floating exchange rate, that the central bank only intervenes when maybe things are too volatile. The only thing they do is to reduce that volatility. But they frequently say that they have never had a preferred exchange rate, that the market should determine where the exchange rate should be, and their work is to just intervene. And right now, the reserves at the central bank are quite low. It's 3.6 months of import cover. It's lower than the 4 months statutory limit. So right now, they really can't intervene, because normally they would sell dollars to stabilize. So right now, they can't do that. So in their defense, they have never really had a preferred position. But what the IMF said, it's true. Exchange rates should reflect the economic reality, and people should adjust. The only problem is sometimes between the theory and the practice. The theory is true. It's good to have a freely floating exchange rate. The only problem is in the short run, if you allow that to happen too quickly, fuel, for example, becomes very expensive, because all our fuel is bought in dollars from abroad. Fuel becomes very expensive. And when fuel becomes very expensive, all economic activities slow down, whether it's transport, whether it's food, when food prices. So I think the IMF's thesis needs to be looked at from a long-term perspective, but you can't just, it can't just happen overnight, because that would create significant price shocks. It would make oil prices so high, anybody doing transport, any doing business would just have to close their business. It's something that from a policy perspective has to be approached it in a gradual way.
Okay. And related to that, there was also something in the media, I don't know how true it is, that the president has negotiated for us to be importing our oil in Kenya shillings from, I think, Saudi Arabia and the UAE. Is that something that's feasible? And what would be the impact on that in terms of stabilizing the shilling, if that was true?
Yeah, that has been doing the rounds, that commentary, and the thinking there has been the big demands on our dollars in Kenya is mostly around oil. So the idea that if you can reduce that dollar demand, then you can sort of stabilize the shilling, because the people who actually end up demanding the most dollars in this economy are oil companies. So the thinking was, if that can be changed, then we can see less demand and sort of like some stability. The problem is most oil marketers that I've talked to tend to do what I call currency swaps. So they still need to have dollars in that sense. So the dollar demand is not going anywhere soon. So I still feel, yes, that arrangement, there are two parts to that arrangement. Number one, it's you have a 6 months credit window where oil will be paid in 6 months. I think what that does is it just defers the time, but still the amount to be paid is still there. There'll still be dollar demand. So I think it defers, it puts off pressure, but at some point we still have to pay for it. The second part of the currency, whether the choice of currency, that part has not come out very, very clearly. I still see a lot of debate on whether it will be shilling or dollar. That part has not been clear. I think what's been clear is that it will be a 6 months credit period. But even markets, they price it in, and they know in 6 months you'll still need to pay. So for me, I don't see a significant change in the dollar demand. I still expect the demands for dollars to be very high. Manufacturers need quite a bit of dollars. And the supply side of dollars is quite limited. You think the main suppliers of dollars are remittances from the diaspora, tea and coffee. But if you look at most of the remittances coming from the US, about 50% of our remittances come from the US. You know, the US are facing an economic slowdown. So even those Kenyans might not be able to send as much dollars to Kenya as we're used to. If you look at our exports of tea and coffee, our key markets, Pakistan, Egypt, and are strained. So for me, the balance of dollar and of the balance of supply and demand of dollars still is in favor of the demand side, which means the shilling will continue being under pressure. So my forecast, my projection is I expect to see the shilling continuing to depreciate. And also the issue of the Fed. The Fed is still continuing raising interest rates, and that will still continue putting our shilling on pressure. So I think my forecast is for a weaker shilling and a continued depreciation. I do not see a scenario of us going back to 120, as I've been seeing people in the media talking about.
Okay. So now what can businesses do to cushion themselves against the foreign exchange risk, especially the ones that probably receive financing in USD and they have their income is in Kenya shillings? What can they do to mitigate against that risk?
Yeah, so I think the modern day CFO, the modern day CEO has to be very savvy in terms of first following issues, global issues, because it's very easy to listen to the political rhetoric and forget about the facts. So I think it's very important the modern CFO starts focusing on understanding what are the big economic issues happening, and also to build a bit of modeling skills, not complex stuff, but a bit of some introductory, some modeling skills on how to model currencies. Number two, sometimes banks offer, forward rates that you can lock in. You can try and sort of hedge particular outcomes. The only problem is banks, I don't think there's any bank that will give you more than a 1-year forward rate. Be able to
Could you kindly explain what forward rates would mean?
Yes, indeed. So if you give me dollars today, I would just go and change it at my local bank, and they would give me what is called a spot rate. That's the rate for today as it is. But sometimes I might not want you to pay me now. I might want you to pay me in 6 months. So I can be able to say, I'll go to the bank and say, Kezia will pay me in 6 months, and lock in at a particular rate, because maybe I'm afraid the shilling might slide too fast. So I'm able to lock a rate. So it's just the outlook on the currency in the next 6 months. It's an outlook that banks have over the next 6 months based on where they're saying the interest rates are. So most banks will give you a 6 months or a 1-year a forward rate that they believe is where the currency should be. The problem, with your investors, I'm sure many investors look at 5 to 7 years of, private equities. They look at 5 to 7 years of business before they exit. So for them, they have to be a bit more savvy, because there's no bank that will give you a 7-year forward rate. The world is very unpredictable. So even for somebody to give you a 1-year forward rate, they've really done their best, because so much is changing. I mean, nobody saw Russia invading Ukraine. Nobody saw OPEC countries cutting oil supply, and all these things affect currency. So you'll find the modern CFO today has to build some modeling acumen, a bit of analytical, where you keep track of things such as money supply, inflation, exchange rates. And so I think there's quite a bit of work in terms of that, because yes, you can go to your bank, but the banks can only give you a bit of temporary support. They can't give you long-term support. So I think it's the modern CFO, in as much as the modern CFO is encumbered with the operational part, you're paying suppliers and you're balancing books. But I think the modern finance CFO has to sit back and look at macroeconomic developments, follow macroeconomic developments on a weekly basis, because every week things are changing. You know, somebody who's been holding pound sterling is sitting very pretty today. It's the best performing currency today. So a good CFO should have had a strategy of, you know, I have multiple accounts, shilling, dollars, sterling, you know, maybe I need to do more on sterling. But for you to make smart moves, you have to follow. You have to keep up with events. You have to almost dedicate some time every week to understand where global markets are going. So it's a labor of, it's a weekly, daily labor of it. There's no single sort of like silver bullet that will solve it. It's just keeping up with global economics, global finance, and being able to make some very smart decisions.
Okay. And for small businesses that don't have that kind of expertise in-house, what would you advise?
Well, I mean, this is where I also get to market mentoria. We do provide those services. First of all, as I said earlier, we do have a weekly report that really causes quite a bit happening in the globe, in Africa, and in Kenya. And we try to summarize that in a brief report on what the key things are, the key things are. So we do provide that in terms of a weekly report, but also training. We also provide training on modeling, how to model currencies, how to model interest rates, how to model inflation. Inflation is very important.
Okay, thank you, Ken. Before we continue with the rest of our discussion, I'm seeing a few questions here that relate to what we've been discussing. There's one from Duncan where he's asking, since some of us are on the wrong side of history, in your words, what hedging options would you advise?
Well, please don't take that with a pinch of salt. But yes, now hedging is it's a very nice tool, but you need to understand it, how to do it. It's a good tool if you understand what you're doing. And what do I mean if you understand what you're doing? That you have a good forecast of where you see inflation will be next year, that you have a good forecast of where you see exchange rates being, you have a good forecast of where you're seeing interest rates being. Far too many people end up losing money in hedging strategies because they had a wrong outlook. So you end up locking a rate that is higher than where the market is. So maybe you lock in a rate at a particular level, but actually the market goes down instead of going up, but you are tied to those high costs. So very many companies have made huge losses. And I think I keep seeing KQ in the newspapers, how they've had some tough hedging strategies in the past. So it's a good hedging strategy is fundamentally based on good forecasts. So, and good forecasts are an outcome of quality modeling. So you have to have a good forecast so that when you sit with your bank and you look at your forecast, the bank will give you its forecast, because the bank is there also to make a profit. It's not doing it out of charity. They put a margin on a profit. So I think sometimes people go to the banks just, direct, and maybe sometimes they may not make the most. So I think I'm doing a bit of internal modeling and analysis before you go to the bank makes the world of a difference.
Okay, thank you for that. One last question before we continue. I'm seeing there's one from Jason where he's asking why the oil marketers would still need the dollars while they can buy and sell in Kenya shillings.
I think it's just the historical nature of oil marketers. Traditionally, many of them have been using currency swap tools. These are tools that sort of help you manage your costs, particularly if you're doing in the import-export business. So I think it's just been a tradition for a long time. And this arrangement, the G2G arrangement by government, it really came as a surprise. It was a new thing that came. So oil marketers already had their own arrangements with how they manage their exchange rate risk. So over the next few months, as government sort of clarifies this government-to-government arrangement, I think now oil marketers will be, because I know some of them have gone to court, they have said this process is not very inclusive. So I think over the next 6 months, the market will recalibrate, so that everybody knows what their expectations are, what are their roles, what are their responsibilities. So it's something that we continue to monitor every day, because the situation keeps changing every day. But what we do know now, when we talk to all marketers, they still say they need dollars because they have currency swap positions that they need to fulfill. So that demand still remains.
Okay, thank you so much. And then now looking at the opportunities that exist with a depreciating shilling, what are some of these opportunities that entrepreneurs can bank on?
I think entrepreneurs who are in the export business will do very well. As I said, a weaker currency favors an export business. And that's why China is always devaluing its currency. And that's why America is always accusing China of devaluing its currency, because China knows the weaker its currency, the more it can export to the world. China is the workshop of the world. So I think for Kenyan exporters, it's a good time to export. And right now, I think I was seeing yesterday, our leadership team, the Cabinet Secretary for Foreign Affairs and Trade in the United States, as we speak, they spoke to the Harvard Club of New York yesterday. They will wooing American investors to come to Kenya. And somebody holding dollars, I'd also say, is sitting pretty, because Kenyan assets become very cheap because of that exchange rate. So if something was expensive, let's say like real estate, if a real estate $1 million or a $10 million project last year was very expensive, now it becomes much cheaper. So they're trying to woo in foreign investors to come in and be able to do it. I think the problem is we've not marketed Kenyan products in the US very well. If you look at the things we export to the US, it's very, say, it's your knitted suits, knitted socks, apparels and stuff, but we don't do much coffees, we don't do much tea, we certainly don't do technology. So I think that Kenya-US relationship is it's a very good opportunity. I think, and with the current ambassador, who is more of a business lady than a diplomat, I think we have a very good opportunity to rebrand Kenya, to sell Kenyan products in the US in a proper way, not just the apparels that are done in the EPZs here, but proper stuff. There's an arrangement called AGOA. AGOA is the Africa Growth and Opportunity Act, but it just allows certain items. It doesn't allow agricultural products, but Kenya is strong in agriculture. So I think if Kenya can get a bilateral arrangement with the US and we can be able to sell, there's a lot more. We can make so much money, as a country. If you talk about, some of these horticultural items, like a mint, for example, mint is about 30 US cents here in Nairobi, but when you go and sell it in New York, it's about $4. You can see the profit margins are quite big. So I think for me, an exporter who's looking at the American market, I think should be able to say, this is an area I want to monitor and start exporting, the way China is opening up to avocados, for example. So I think exporters need to really look at their opportunities, and also services, consultants, we don't just export goods, we also export services. So somebody who's doing consulting work needs to look at also international markets, because you can price your services in dollars and make some very good change.
Okay. And are these opportunities that one can tap into without really having the government-to-government arrangements?
Absolutely, especially in the digital world, for example. I think COVID, in a way, has been a blessing in disguise, because it has opened us to a global environment digitally. So the fact that we can have this kind of Zoom conferences globally, and you can provide a training, you can provide a session, has created immense opportunity. And right now, there's something called the Africa Continental Free Trade Agreement, where you can sell your services all over Africa. And they're really trying to focus on the digital component, because in the digital space, all you're doing is with your laptop, with your software, you're able to serve the world. So you can sell your content to the world. So people who are like digital marketing, your clients should not just be in Kenya, should have clients in Nigeria, clients in South Africa because all your products are being transported digitally. You don't have to deal with the trucks at the borders, the non-tariff barriers. So I think people in services are going to sit very pretty because the barriers are less in the service industry. You can do a lot more work for international clients. And for those international clients, it's a good thing because they are, from their perspective, they're able to get quality work at a cheaper rate. If you want a software developer, an American software developer is very expensive, but you can come to Kenya and get the same quality software developer at a fraction of the price. And for that quality, you can be able to do more. So I think there's a lot more in the services space, but also in the physical goods space. I still feel horticulture is a very good space that's really growing. I think there's a lot of opportunity in that area. And next week, the economic survey will be coming out. I think it's important your listeners also know that the economic survey will be coming out on Wednesday. It was supposed to come out yesterday. I think it was postponed to Wednesday. And this is like the Bible in terms of where the economy is. And it's the latest, and it'll have fresh data on anything you want, whether you want to be a coffee producer, whether you want to be in software. So I think next Wednesday, people should look for that economic survey and jump in. And, you know, we're a net importer. So we, as I said, we import more than we export. So it means we have a local market we don't meet. Even livestock, we import more livestock, you know, than we can, than we produce. We consume more than we can produce locally. So it tells you that there's a big demand that needs to be filled. So I think the economic survey next Wednesday, that's something everybody should make sure they get, of course, after they subscribe to our report.
All right, note to the audience, please be on the lookout and also check what the mentorial group is doing. Now moving on to the PVC space, we know that the investments are usually received in dollars more often than not. And if it's a local company, probably there's a high probability that their income is going to be in the Kenya shilling. So what does that mean in terms of how investors perceive the risks investing in this market, and what's the possible impact on the ability to meet their target returns at the point of exit, which is usually in 5 to 7 years?
That's a very good question. And we do see quite a number of businesses like that. I believe a company like Garden City, the mall, I think the tenants were paying rent in dollars. But obviously the tenants are receiving their money in shillings. So for example, if you are selling fashion items at the mall, you're paying your rent in dollars, but the people are paying you in shillings, and that can create some sense of imbalance in terms of, particularly with that exchange rate. I think there are a number of things that a PE firm needs to decide at the beginning. And this is something I've talked about PE firms. I think at the very beginning, when they enter the market, they need to have a long-term interest in the market, a long-term interest. Yes, we do know that they are there for 5 to 7 years before they exit, but they have to be alive to the fact that emerging markets, not just Kenya, but emerging markets across the world are in a similar situation as we speak. So when interest rates in the West go up, the exchange rate will slide. Most of these emerging markets are net importers. So I think a good PE firm has to be alive to the fact that the shilling, the outlook, as long as Kenya is a net importer, will be bearish against the shilling. So I think that understanding has to be there, even as they calculate their models. I think for me, a good PE fund would be one that domiciles its funds within the particular region, like Kenya, for example, so that even after 5, 7 years when you're exiting, you're looking for another investment opportunity in the region, for example. So let's say you bought a startup for 5 to 7 years after you exit, to try and look for opportunities within the same economy, so that that currency change sort of is not a significant part. I think the more you stay within the same economy, the less that effect is felt. Otherwise, if you are exiting an industry and exiting a country, you're always being hit by those risks. So I think I'd say number one, PE firms should consider domiciling sort of their businesses within a region. They need to take a long-term view, say, we like Kenya, we like the macroeconomic fundamentals, so we need to be in Kenya. So even if we exit from this high-end school, we'd like to put the money in a high-end manufacturer. We'd like to put the money in a real, so we need to be in Kenya. We need to do our business in Kenya. I think for those ones that have a long-term commitment, they are likely to be a bit more protected. Obviously, as I said earlier, you can maybe try to do a bit of hedging, but the investment duration of a PE firm is 5 to 7 years. So there is no bank that will give you a forward rate for 7, 8 years because everything is volatile. So I would say, as you do your 1 year hedging strategies, keep an outlook on macroeconomic fundamentals, do a bit of modeling so that as you do your 1 year, every 1 year, you're sort of like moving from a well-guided position. But other than that, the market is what it is, and we just have to work within that context.
Okay. I'm seeing we have 9 more minutes, so I'll just try and wrap it up. And if there are any burning questions, please type them in the chat box. So lastly, we have this idea of apologies for that. So there's been this discussion around de-dollarizing. So it's something that has gained a lot of momentum, given that China and Brazil and India are getting into agreements that allow them to trade with their own currencies. What does that mean for the USD as a reserve currency? And we'll tie it into a question that has been asked by Adelaide, where she's asking if this presents an opportunity for cryptocurrency as an option.
Excellent question. And let me give a brief background on that particular situation. So for the longest time, the world has really been tied to the dollar as a global reserve currency. This was particularly so in 1971, when the dollar got off the gold standard, and really most oil deals, particularly between the US and Saudi Arabia, were underwritten in dollars. That was a big turning point because if you needed oil, you needed to have it in dollars. And by that virtue, it has made the dollar to become what you'd call a global reserve currencies. Now much has changed over the last 70 years. As you said, the IMFs, the World Banks, what you'd call the Anglo-Saxon tradition has sort of like worn off a bit as countries have been facing east. You remember here in Kenya, from the year 2008, we've been looking at China as a potential partner in many areas, the whole facing east. So the world is now getting to a place where we are a multipolar world. We're not just dominated by what was called the Washington Consensus, but you're a multipolar world. And the phrase you use, BRICS, that's Brazil, Russia, India, China, and South Africa. It's pointing to our what is called a multipolar world, where power is not just sitting in Washington and its Washington allies, but it's sitting in India, in China, in Brazil. So the world is becoming multipolar, and that's from a geopolitical perspective. But geopolitics leads to geoeconomics, and those countries have now come up to do businesses amongst themselves. In fact, last week in our report, we talked about the BRICS contribution to global GDP is about 31%. If you add the economies of Brazil, Russia, India, China, South Africa, it's about 31% of global GDP. If you look at the G7 economies, which are allied to the US, the West, it's about 30%. It's telling you that the G7 currencies are sort of somewhat behind with the rising BRICS. So it presents a new opportunity for countries like Kenya to be able to, as you say, right now there's a dollar shortage, not just in Kenya, but in many countries. So it presents a new opportunity for countries to conduct business in multiple currencies, which is a good thing. So if you don't have enough dollars, it should not be the end of the world. You should be able to buy your oil in Russian rubles or Chinese yuan. So I think it's a good thing that the world we are moving towards multiple currencies, which is a good thing, because if you're out of favor with one country, you can still participate in globalization. Globalization does not have to corner you to one currency. So I think it's a good thing. I think it will create more options. And I've seen the likes of Tanzania signing arrangement with India to buy their oil from India. And India is becoming a big spot in Russia and India. So I think it's leading to a multipolar world where many people will be able to participate much more in globalization.
Okay. Do you see crypto replacing the USD at some point?
Not quite crypto. For me, I expect other countries to come in, the Chinese yuan, the Russia rubles. We'll have a multiple currency world. For the cryptocurrency there, cryptocurrency has a positive and it has a negative. The positive part of cryptocurrency is it can allow for global trade very quickly. If I wanted to buy a car in Japan, I can go to my crypto wallet and really, I don't have to go to my bank to change my shillings to dollars or to yen, and to wire somebody. If I have a cryptocurrency, I can be able to buy that transaction, and it's secure and it's verified. That's the positive part. The negative part of cryptocurrency is it's twofold. Number one, you don't have any official constitution support for it. So in the event that I was to sue you or you are to sue me, there is no court that we can go to because there is no government sort of backing towards it. Currencies are what are called fiat currencies. Fiat means they derive their authority from the law. So the Kenya shilling derives its authority from the Kenya government. The US dollar gets its authority from the American Constitution. Cryptocurrency is not supported by any. So if you are to get any form of enforcement, there is no government, that would enforce it. And number two, there is also a limit to the number of, particularly Bitcoin, because there are many cryptocurrencies. Bitcoin has an upper limit of about 20 million units. The world's population is constantly growing, and we need more and more money. So when we hit that limit, it might be, in fact, that's what happened to the gold standard. That's the reason the gold standard could not continue. There wasn't enough gold in the world to be able to keep up with business demand. So those are the two main challenges. So I don't see crypto, but I do see, people talk about the central bank digital currencies. I find like there's a bit more promise there because these are central bank, they're banked by an actual central bank. So there's enforcement, but I do see opportunity in what we call the CB. This is the central bank digital currencies.
Okay. Thank you so much, Ken. And as we wrap up, I would like to ask you to give your parting shots and tie it in with this question from Mercy, where she's asking, how can businesses that majorly import prepare for and manage these depreciations without swallowing up their profits?
Yeah, Mercy's question.
We have 30 seconds.
Yeah, Mercy's question is a perennial activity because you're constantly managing two currencies. Any business that is managing two currencies has to be constantly doing its structured arrangements. So you need to do a bit of modeling and a bit of work with their local bank or your local treasury or your local consultant. So it's not going away, it's always be there. But I think my parting shot would be still for Kenya's businesses. I think there's still quite a bit of opportunity. I think the government is still open to business. Kenya remains one of the best places to do business in terms of just what I talked about earlier. And these issues of the macroeconomic fundamentals should not discourage somebody because these are things that can be managed within the business model.
Okay. All right. Thank you so much, Ken, for coming and sharing your thoughts and your experience and expertise with our audience. We really do appreciate, and to the audience, we thank you for joining us, and we hope that you have learned a thing or two, and you'll be able to apply them in your businesses or in your personal finance. Thank you, everyone, and have a good rest of the day. Bye.
Thank you. Bye.